Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hey everyone, welcome to Ask Rob and Rob, the show where you give us your questions and each week we come back at you with answers. It's a simple format, a format that's worked so well that we've been going for nearly 500 episodes. So Rob, we can't stop now, can we? Let's remind people how they can help us get another 500 episodes under our belt.
Yeah, thank goodness we haven't run out of questions on 499. That would be awkward. No, but we would always welcome more. So do send them in via propertyhub.net/ask. So simple, just go there. You can leave a written question for the Sunday Times, or our favourite option, you can leave us a recording, dead easy, and get your voice on the show. And that is what Claire has done.
Hi, Rob and Rob. It's Claire here. I'm an avid listener and follower of all the generous knowledge that you have been sharing through podcasts, articles and books. Consequently, we are 7 years along with our journey and have a portfolio of 4 properties. Thanks to inflation, we have now 50-50 loan to value on our portfolio. My question is, what would you advise me to do with a sooner than expected inheritance? The inheritance would totally clear our mortgages. Would you advise me to pay them off? Initially, we had thought that our properties would double in value and we would be able to sell 2 in order to pay off 2. But because of this sudden bereavement and consequential inheritance, I'm not sure of the best way to move forward. Can I also ask about how could we best protect our portfolio to ensure maximum income for our family, our children and ourselves? Our properties were bought in our names and not through limited company, and it would be important for us to protect them from excessive taxes, both now and on the event of our death. So far, I haven't heard much discussion about estate planning and hoped you could point me in the right direction. Thank you so much indeed for all of your life-saving advice, and I mean that wholeheartedly. Thanks to what you have advised us, I was able to retire from a turbulent teaching career and start living our dream. We're forever in your debt. Thank you so much, Claire.
Claire, thank you for your question. This is a really meaty one. I think Rob and I could probably talk about this for an hour, but let's see if I can quickly, in a couple of minutes, pick out the couple of main points that you make there and give you not an answer, but a way to start thinking about this. So, being able to pay off your mortgages is a great position to be in. And of course, if you did that, it would improve your cash flow. So you wouldn't have mortgage payments to make anymore, and that is a great thing. And as the properties are in your own name, and assuming that you're a higher rate taxpayer, then the tax treatment on your mortgages isn't going to be particularly great. So there would be a win in that respect of paying them off. However, as you're probably sick of hearing us say by now, if you've been listening to the podcast for any length of time, leverage is almost the point of property investing. It's the only mainstream asset class that you can safely apply leverage to in the form of mortgages, and that is its big benefit. Because, like you've said, as your plan goes, they will go up in value over time. Your mortgage balance will naturally shrink as a proportion of the value, allowing you to, say, sell one property to pay off the rest. And that remains a completely valid option. So the numerical way to look at this is, what would you do with the money if you didn't pay off your mortgages? And what do you anticipate that the rate of return would be on whatever you do with that money? Assuming the answer isn't go on lots of holidays, assuming you invest the money, then what would the rate of return be on that? And how would that compare to the rate of return on paying off your mortgages, which you know because you know what the interest rate is. So you know what the answer would be there, and then you do whichever comes out ahead. In reality, of course, no one makes decisions based solely on the numbers. So a lot of it's going to come down to, well, what makes you feel comfortable? If you just flat out feel better being mortgage free and you don't have this ambition to push on and acquire more and more and more, then that's not a bad thing to do. Even if it's not financially optimal, if it gives you peace of mind, then that is fine. And of course, it doesn't have to be binary. I think we tend to fall into this binary thinking of, do I do this or that? Well, it could be both. You could use some of the money for some type of investment and some of it to pay down your debt a little bit. But it really does depend on where you are and what you're pushing for. Some people, given a sum of money, will go, great, I've got a plan to get to 10 properties. This will allow me to get there faster. Others will be happy where they are and just want to be debt free. Neither is right or wrong. But this does also tie into the second part of your question, which is about how you protect your portfolio and about estate planning. And I think it may be worth getting clear on that part first, because that might determine to some extent what you do with the money, or at least how you structure what you do with the money. Because as you've said, the properties are in your own names. If they were in a limited company, that would give you more flexibility when it comes to estate planning. That doesn't mean there aren't any options when you've got property in your own name. There are. But also there is the possibility of moving them into a company structure. Now, as we've said on the podcast multiple times, if you do just sell the properties from yourself to your company, the tax consequences in terms of capital gains, stamp duty are not good. But given that you've got 4, there is the possibility that you can move them into a company over time, completely legitimately via a partnership. And that's something that we talked about with a tax expert on our YouTube channel recently. So we'll link to that video in the show notes. Recommend you'll go and give that a watch. That should be the start, not the end of your research on this. Use that as a jumping off point to understand what's possible, and then go and take some tax advice. It will cost you a bit of money, but it will be well worth it, because it will save you so much more in the end. So what I would do, Claire, is do that research, then take some tax advice, and then with that knowledge, think about what you want to do with the money, looking at it through the lens of both what's financially the best thing to do and what makes you feel more comfortable, and see what feels right at the end of that. So I hope that helps, and good luck.
Next up, we have a question in from Danny.
Hello, Rob and Rob. It's Danny here. Thank you, firstly, for the content you put out on the podcast on YouTube. It's very helpful, so big thanks for that. I was hoping you could give me some guidance today, in the sense that I have 2 properties in my own personal name and debating whether to keep them or sell them. So property 1 was once my primary residence. It's a 1-bed masonette in a place called Haroldwood in Romford. I bought it in 2008 for $149,000, and it's now worth approximately $270,000. I have no money left in, as I refinanced to buy my second buy-to-let in 2016, also in my personal name, and then refinanced again to pull out equity to go towards our main residential home. It's in a strong location, close to the station, so good for commuters, and is always rented out solidly. Property 2 is a studio flat in Brentwood, again in good reach of the train station, and is a solid rental for workers getting into London. I bought this for $160,000, and it's now worth approximately $200,000. Property 1 brings in about £370 a month. Property 2 brings in about £160 a month. I suppose it's important to note that I have my own business and I keep myself in the lower 20% tax bracket. So the thing ultimately I'm looking for a little bit of guidance on is whether you think I should keep them based on their performance so far, or whether I should sell up and invest in a limited company. Now, on that front, I have just had an offer accepted on another property in Essex, and I now know through education, partly through you guys as well, that I'm best investing through a limited company. So I've now got a limited company set up, and that third buy-to-let will be in the limited company. So what I would like a little bit of help around is if you think it's worth keeping those properties in my personal name and obviously sucking up the fact that I pay a bit more tax and get a bit less interest rate relief, etc., or whether you think I should perhaps look into selling them and buying elsewhere. As a bit of a side note, the tenants have been very long-term tenants in these properties, not give me much headache, and they're strong rental units. So my heart tells me to keep them in my personal name, but my head and my financially savvy side of me says perhaps look into selling them and putting the money to work better somewhere else within the limited company. But thanks once again. Your opinions and guidance on this will be much appreciated. Thank you.
Danny, thank you for your question. It's an interesting one. And I can understand why you've posed this question, because you're right. We do talk about how in the majority, not all cases, but in the majority of cases, the best way forward is investing through a limited company. Now, that's not tax advice. Speak to a tax advisor. If you're listening to this, there may be a reason why you shouldn't go down that path, but for a lot of people, it's the main route. Okay, so with that said, should you sell your properties in your own name and now go and buy in a limited company instead? The answer is probably not. And that's because of transaction costs. Property is a long-term game for a few reasons. One, because the benefits you'll really see over time. But two, the transaction costs are really expensive. And buying and selling properties is something that you really want to avoid when you can. And you've done that already. You've refinanced rather than selling to extract money out those properties. And then that gave you the chance to go and invest and put money into your own home, which is great. The only caveat I give here is if you have problem properties, so these properties give you constant headaches, the tenant profile of those properties means that it's always issues, or a property has a lot of maintenance issues, so your profits are consistently wiped out. If you find that you've got one of those properties in your portfolio, then maybe you could consider selling it, because while you do still have those transaction costs, there are costs of running that property because it keeps giving you headaches. Now, hopefully you've got 2 properties that are fairly normal, that occasionally things go wrong, because it is property, things do go wrong, but it's not enough to force you to sell and then reinvest through a limited company. But sometimes you have them, and the bigger your portfolio gets, the more likely you'll see it, is that you have properties which are just a pain in the bum. I've certainly got 1 or 2 in my portfolio for different reasons. It just happens. Even with the best of research, these things happen. Some people deal with it better than others. But if you do have one of those properties, then run the numbers, look at the pain that you're going through and say, okay, can I remove this pain with these transaction costs, go and invest in a stronger area potentially, because there are probably stronger areas than where you've invested right now, and see the upside. And that's a decision to be made. But as I say, Danny, that is probably the exception rather than the rule. Most people listening to this, if you are in a similar situation to Danny, the answer for most of you will be to hold. But there are situations like a problem property where you can consider the option of doing something else. Good luck.
Well, there you go. Claire and Danny have their answers, and you could as well if you send your question in. So do that at propertyhub.net/ask. We will be back with episode 500 next week. Whoop. And of course, we'll also have the Property Podcast. And before then, of course, on Thursday, we'll have the Property Podcast. So we'll see you then. Bye-bye.
Bye-bye.